Hello, everybody, and welcome to the Canadian Money Talk. Today I went to an in-person tax and retirement seminar, and there were several questions which showed people didn't know some of the basics, so I'll kind of go over the top four. Number one is the marginal tax rates in the graduated tax system in Canada. As you make more money, you pay more taxes. The tax rates increase, but they increase only for the tax bracket. If you make one more dollar, you don't pay the higher tax rate on all of your income, only on that $1. If you make an extra $2, you pay the higher tax rate only on the $2 in that higher tax bracket. If your take-home pay actually decreased as you made more money, nobody would try very hard. So your average tax rate is a lot lower than your marginal tax rate. So that's an important distinction. Second one was dividend reinvestment plans, or DRIPs, in a non-registered account. I've heard this multiple times over the years, where people think that if they're automatically reinvesting dividends in a non-registered account, that there's some sort of a tax benefit, and there isn't. It's your decision to reinvest the dividends. You could have taken that cash out and gone to the pub with it just as well. It's your decision to reinvest it, so there's no tax benefits there. Thirdly, RSPs are now, by the retirees at that seminar, detested because they're paying a lot of taxes on the withdrawal, and they forget that 30 years ago, when they were hopefully in a higher tax bracket, buying the RSPs gave them tax relief, and then the money grew tax deferred, which is valuable. They had more money to have growing since taxes weren't being pulled at the time. The government helped you and incentivized you to save for retirement, and now they want some of their taxes, hopefully in a lower tax bracket. If you have a lot of RSPs, start pulling them early to level out your taxes. And lastly, people who now hate the RSP wish they were using the TFSA instead, but they don't know how it works. They don't understand that the limit recycles the next January if they pull money out. They don't understand that it's an investment account despite the S standing for savings in the name, or that you don't get a tax deduction when you invest in a TFSA. So those were kind of the top four. I hope I shed some light on the misconceptions for retirees in this area and Canadian investors in general. If you think there's others or stuff you don't understand, let me know in the comments and I'll compile them into a video.